This is the future of finance.
This episode is brought to you by Metis Global Partners. Hi, everyone. Welcome to the Future of Finance podcast. I'm George Dyer, and today we're sharing another in our series of presentations from our virtual forum held back in June. This one is from Sara Murphy, who at the time was the Chief Strategy Officer at the Shareholder Commons, which is a nonprofit focused on system-level investing and specifically systems stewardship. Since then, Sara has actually moved on to the Sierra Club Foundation, where she now serves as the Director of System-Level Investing. This continues a series of conversations related to system-level investing and fiduciary duty. We recently dove into these topics in our episodes with Bill Burkhart from TIP, Brian Minns from the University Pension Plan of Ontario, and Ellen Quigley from the University of Cambridge. So I encourage you to check all those out. And Sara's presentation really shares the Shareholder Commons work around system stewardship and how externalities from some companies might help those specific companies, but can hurt other companies in an investor's portfolio, especially if those investors are universal owners. So investors have the incentive to have companies limit those damaging externalities, even if that might add costs or limit the short-term profitability of those individual companies. It's a fascinating dive into these concepts, which are so important for investors in the 21st century, dealing with these 21st century sustainability challenges. So I hope you enjoy it. Please be sure to like and follow the show, share it with your friends, and subscribe to our YouTube channel if you haven't already. And now here's Sara's presentation.
Thanks for having me on today. In 2021, powerhouse law firm Freshfields Derringer issued a report, a legal framework for impact, that presaged a new era of stewardship for institutional investors. The framework established beyond a doubt that institutional investors have a fiduciary duty to address corporate behavior that threatens the social and environmental systems that undergird investment portfolios. This means those powerful investors can't restrict their stewardship efforts to ensuring that portfolio companies maximize their own value. Investors must address companies' systemic impacts as well, even when doing so reduces the relative performance of some of those companies. The PRI has issued its own call to action, Active Ownership 2.0, urging investors to prioritize system stewardship to protect the value of their portfolios. Columbia University professor John Coffey described this new form of stewardship starkly, and I quote, "This latter form of activism is less interested in whether the target firm's stock price rises or falls than in whether the activist investor's engagement with the target causes the total value of this investor's portfolio to rise, which means that the gains to the other stocks in the portfolio exceed any loss to the target stock. This recognition that change at one firm can affect the value of other firms in the portfolio implies a new goal for activism, namely to engineer a net gain for the portfolio, possibly by reducing negative externalities that one firm is imposing on other firms in the investor's portfolio." Close quote. Successful implementation of the practices anticipated by the framework and Active Ownership 2.0 would be more significant than any public policy initiative or technological advance alone could be in addressing the critical challenges facing the global community. That significance derives from the financial industry's role in allocating productive resources. At this point in history, deciding what we produce and how we produce it may determine whether humanity survives into the next century. These allocation decisions are being made in real time with respect to AI, I know you've discussed that at length, carbon emissions, biodiversity loss, and practices that expand the gaping inequities in our economy. Without a shift to investor-endorsed system stewardship, it will be difficult, if not impossible, to address these challenges because current financial industry practices are in many cases a leading source of threats to systemic health. The conventional prioritization of individual company performance over all else creates powerful, possibly insurmountable headwinds against regulatory and other solutions. This prioritization of companies over systems is the result of a conflict of interest that's deeply embedded in the financial system. System stewardship is a way of altering that structure. Simply identifying the conflict is essential because once you see it, you can't unsee it. So here it is. As a financial industry participant, which of the following two outcomes would you prefer for the next year? Scenario 1. Overall, the market returns a tepid 2%, but the portfolios for which you're responsible return 4%. Scenario 2. Overall market returns a frothy 7%, but the portfolios for which you're responsible return 5%. You're going to attract more clients or earn promotions and bonuses in scenario 1, where you doubled the market return. But in that scenario, your clients or beneficiaries did 20% worse on an absolute return basis than in the second scenario, where you underperformed, putting your career objectives at risk. In other words, your clients, your interests are different from the interests of the people for whose money you're responsible. That's the conflict, and it exists up and down the chain of investment. It's important to say that identifying this conflict implies no moral judgment. A conflict of interest is simply a state of affairs, but one that should be candidly addressed. To ensure that companies are run well, we prioritize their individual returns. But in measuring such returns, we inevitably must compare them to other companies. As a result, the financial industry focuses on optimizing relative returns of individual companies, not absolute returns received by actual investors. It's helpful to consider the context of this mismatch. There's a long chain of stewardship between savers in the real economy. There are allocators, consultants, managers, sub-advisors, and proxy advisors. And beneath all these intermediaries, there are the directors and executives of the companies themselves, the final link in the chain of stewardship. At each level, there's discretion over how assets are deployed. As with any agency relationship, that discretion can be used in a manner that benefits the agents rather than the principals. That's what a conflict is. This risk first manifests at the company level. Will companies deploy capital in a manner that most effectively creates financial return? This issue came to a head in the early 20th century as industrialization and economic growth created large public companies with broad, dispersed shareholdings. There was concern that this separation of ownership from control would lead corporate managers to misuse investors' capital. The history of corporate governance and finance in the 20th century can be viewed as a long, slow development of strategies to address this concern and to ensure that corporate executives were prioritizing financial returns to shareholders. This history is reflected in many familiar aspects of the financial system. Equity compensation and private equity carries create financial incentives to focus on company financial performance, and disclosure regimes are based on company performance. Success in a career in asset management depends on whether individual companies chosen for active portfolios outperform their peers. None of these elements is inevitable. They're designed to alleviate risks from the separation of ownership from control. However, our solution to the 20th century problem of a conflict at the company level has overcorrected and led to the far more dangerous 21st century portfolio level conflict I just outlined. Here's the connection. These mechanisms designed to address the company-level conflict all rely on a very specific heuristic. They assume that relatively higher financial returns at any company are always good for the savers whose capital is being used at the company. We treat alpha, a company's individual financial performance, as an unequivocal measure of success. But while that rule has utility, it's at best a rough approximation of reality, because investors' ability to fulfill their goals is determined by absolute overall returns of their portfolios, not the relative or individual performance of those portfolios' components. You might ask whether this conflict resolves itself in practice, since returns at individual companies should lead to increased returns at the portfolios made up of those companies. Don't the different perspectives merge? The answer is no, or at least not always, because the methods used to maximize returns at one company can threaten the systems that support others. To understand this distinction, let's come back to where this whole forum started on Monday, modern portfolio theory, which requires diversification across many companies. While some managers may themselves focus on concentrated positions, the beneficiaries they're working for will almost certainly rely on diversification as a tool to stay on the efficient frontier of combined risk and return. Indeed, the law generally requires fiduciaries to diversify. So this is where we begin to see the divergence between the individual company perspective and that of the portfolio. For a diversified portfolio, the key determinant of financial performance is how the economy performs. Any investor's return has two components: beta, the overall performance of markets, to use a shorthand, and alpha, the amount their portfolio diverges from that baseline. That beta baseline is a directly correlated function of the global economy in which those markets are invested. As a result, the overall performance of the economy is by far the most important factor underlying the absolute return of any diversified portfolio. In this context, it's worth remembering that the average alpha for all investors is 0, meaning that on average, beta is the only source of return. Yet under the current investment paradigm, no one in the chain of investment, from allocators down to corporate officers, is assigned responsibility for that performance. It's treated as something with which those fiduciaries cope. With this reality in mind, let's return to the alpha heuristic, rewarding allocators, managers, and executives for positive alpha. This rule treats all alpha equally, but many of the methods used to increase alpha threaten the social and environmental systems that undergird our economy, and this threatens overall market return. A few years ago, economist Raj Patel calculated that a $2 fast food hamburger actually costs more than $200 when deforestation, carbon emissions, degraded public health, inequality, and other externalities are priced in. So while Burger Co. maintains high margins and revenues, the economy loses value. That value extraction doesn't just threaten the economy. It also threatens the diversified portfolios of Burger Co.'s own shareholders, because a diversified portfolio in an economy burdened by nature loss, inequality, and climate change is a less valuable portfolio. The more money Burger Co. makes increasing alpha, the greater the threat to overall market returns of diversified investors. There's an inverse relationship between Burger Co. alpha and returns to most investors. Yet Burger Co. executives and active portfolio managers who overweight Burger Co. are rewarded in an alpha-first financial system. Mechanisms put in place to protect savers from conflicts at the company level actually incentivize agents up and down the chain to have companies externalize costs to the detriment of diversified investors. In this way, the financial industry's bias toward alpha is responsible for many of the systemic risks we face. Some deny this relationship between negative externalities and greater profit. They say companies can't really benefit from externalizing costs because the externalization will be reabsorbed by the company when it loses reputation or is subject to regulation. For this reason, it's said that over the long run, companies can only do well by doing good. But it's a fantasy that all externalities get internalized. Tobacco companies made huge long-term profits by addicting and poisoning customers. Smoking costs the U.S. economy 3.8% of GDP, equating to a 3.8% reduction in the value of a portfolio diversified across the U.S. economy. Climate's another example. It's often claimed that fossil fuel companies should reduce exposure to the carbon economy because such assets will lose value when the economy transitions to other energy sources. Yet the markets for their common stock, the right to all future cash flows, account for the calculated risk those companies are taking and reward the continued construction of new fossil fuel infrastructure, even though many of the investors who make up that market believe this behavior is likely to damage the economy. The impact of externalities on a company and on portfolios doesn't resolve or converge regardless of time frame. As to regulatory risk, well, I'm not holding my breath. Singapore's sovereign wealth fund recently quantified the conflict. 40-year cumulative returns of a conventional 60-40 portfolio will suffer by as much as 30% if we don't address climate change quickly, even using current climate models that fail to factor in difficult-to-model aspects such as tipping points. 30% is the difference between a 30-year-old saver running out of money before they die and not. More examples. Many corporate practices increase inequality, but each percentage point increase in inequality creates an equivalent reduction in GDP. Food company overuse of antibiotics improves margins, but contributes to an antimicrobial resistance crisis that will cost the global economy $100 trillion between now and 2050 if not abated. The uncontrolled race for AI-enabled search engines is a very scary recent example of company profit trumping systemic health in financial decision-making. This is just a sampling of the inverse relationship between profit through cost externalization and absolute market returns. Despite this threat to diversified portfolios, our current system rewards the companies that create these costs and the investment professionals who overweight them. The threats to critical social and ecological systems are mounting not in spite of our system of allocating capital, but because of it. Finding a way out of this conundrum is essential if finance is to fulfill its duty to investors. So let me turn to highlighting how system stewardship can address this. I hope it's clear that investment stewards must stop rewarding alpha that's achieved by externalizing costs. But we can't just stop rewarding alpha because it plays an essential role in motivating corporate managers. We must distinguish the good from the bad. In practical terms, this means resetting our strategy and vocabulary around social and environmental stewardship because the external costs are largely costs to social and environmental systems. Right now, stewardship mostly marches under the banner of ESG integration, claiming that companies should improve their social and environmental impacts to increase alpha. Few stewards acknowledge that some companies must reduce returns to preserve systems. Everybody wins is a tempting trope. That a carbon budget or living wage will increase long-term company value might seem like the best argument for shareholders to make because it's most likely to be accepted by corporate management. It's also an easier discussion. But that strategy is misguided and self-defeating. First, it simply aims at the wrong target. The greatest danger to portfolios and sustainability outcomes doesn't lie in companies making mistakes about how to maximize cash flows. Moreover, it's simply playing to the company's strengths. Corporate executives are very good at figuring out how to make money, and they respond to markets that value the expected cash flows from those profits into perpetuity. What executives are not equipped to do is address systemic risks, and markets provide them no feedback on their impact on other companies. In contrast, the success of diversified investors depends on absolute returns, which in turn depend on preserving social and environmental systems. Thus, a shareholder's argument that a company must change a practice to protect diversified portfolio value, even at a cost to alpha, is the most credible argument shareholders can make because it shifts the argument away from the corporate management's bailiwick and share value. Finally, ideas matter, and focusing stewardship arguments on individual company reifies the false promise of company value maximization as the sole guiding principle of corporate governance and finance. The only way to break the cycle is to confront it head-on, and portfolio value arguments present the clearest opportunity to do this. More practically, what does this mean? What should you do differently if you believe the alpha conflict needs to be addressed? The good news is it doesn't require any change in security selection, since neither buying shares on the secondary market nor divesting them has any appreciable impact on corporate conduct. System stewardship is all about engagement and voting, making sure companies aren't engaging in conduct that threatens your entire portfolio. That can't be done with a company you've sold or never bought. The cost externalizing company that you divested from your portfolio is still a danger to it. What system stewardship does require is an open and clear philosophy of portfolio-first voting. This means asset owners must insist that shares held on their behalf are voted to protect their portfolios. If a manager or proxy advisor is only considering the impact votes have on the company where the votes take place, but not on the client's entire portfolio, then they're serving the company's interests and not the client's, and that needs to be fixed. For instance, we know ISS sometimes supports all a company's directors under its benchmark policy, but recommends votes against some of those same directors under its sustainability policy, which isn't available to many fiduciaries because of its dual mandate. That happened with Woodside Petroleum over climate change recently. Given that most of the ultimate beneficiaries of ISS's standard advice are diversified, and everything we know about the risk climate change poses to a diversified portfolio, that's insane. It's not tenable for a proxy advisory platform to be used by any diversified shareholders if it's not factoring in the sustainability impacts of voting decisions on the entire portfolios of those clients. Say to proxy advisors, the savers we represent will be more affected by a failure to meet the Paris goals than by any single company's loss of margin. So as fiduciaries, we need you to give us recommendations that help get the economy as close to 1.5 degrees as possible, regardless of individual company impact. And engagements should be fought on the same ground as well. Managers and advisors need to offer services that clearly account for their clients' entire portfolios. BlackRock CEO Larry Fink recently said it was not his job to decarbonize the economy. He could not be more wrong. With the voting power of more than $11 trillion under management, BlackRock certainly could have a role in such decarbonization, and nothing could be more important to its clients' portfolios. The tools for adopting policies and writing mandates along these lines are out there. My organization has them for free on our website, and we're not the only ones. A year from now, there's no reason an asset owner couldn't have policies and agreements in place to assure their shares are being voted on a portfolio basis, aiming to stop conduct that increases company alpha but threatens overall returns. To boil it down, It's time to adopt the simple Hippocratic principle. First, do no harm to my portfolio. Thank you.
Thank you so much, Sarah, for such a great presentation.
This episode is made possible by Metis Global Partners. A global equity solutions provider managing over $5 billion, Metis offers both active and customized beta strategies for institutional investors. Through their guided beta product suite, Metis provides custom passive equity solutions to clients desiring sustainably aligned equity and real asset portfolios combined with a high-touch partnership. Founded in 2013 in San Diego, California, Metis serves a wide range of institutional clients including foundations, endowments, nonprofit, university, public plan, corporate, and family office clients. To learn more, visit www.metisgp.com. That's metisgp.com. Or email info@metisgp.com.
A reminder to everyone, if you have questions, to please put them in the Q&A or the chat. I have a couple here. One, I was just wondering, you mentioned at the end there some resources you have on the Shareholder Commons website. Could you just share some specific examples of system stewardship in action, maybe the guardrails shareholders have utilized to hold companies and their executives accountable?
I swear I didn't ask her to ask that question, but I certainly appreciate it. So we think the tip of the spear tool is what we describe as guardrails, and that's sort of what I was alluding to in my talk. It really is fairly simple in its articulation, if not necessarily in its implications. It's really just that investors should have, on any given systemic risk, a minimum set of parameters within which they want the companies they own to operate so as not to be externalizing costs onto their broader portfolios. So if we take climate change, a guardrail might be a carbon budget, right? In the case of antimicrobial resistance, it might be compliance with World Health Organization guidelines. On wage, it's paying a living wage. And so we think that that's the tip of the spear for investors to implement, and those guardrails should be expert mediated. They shouldn't be industry defined. And all it requires is that an investor say, we think that this is protective of our portfolios. And so, of course, we're going to exercise our stewardship prerogatives in the service of that objective. So it's basically just a rules-based voting strategy. Now, we realize that, for institutional investors, various other things have to happen to implement a guardrail strategy. It can mean that they have to update their proxy voting policies. It can mean that they have to rewrite their asset management mandates and so forth. So we have various white label products that help them to do that, to integrate system stewardship into the way they put forward those policies and expectations into the marketplace. So that's all on our website at theshareholdercommons.com. And I'm very bad at splitting my attention, but I will try to drop it in the chat in a second.
Great. Thank you. And then do you have thoughts on how investors should measure success when it comes to system stewardship, whether it's that policy adoption or responses to their strategies? And are you seeing any metrics or frameworks emerge that you would recommend attendees look into in addition to the resources on your website?
Yeah, it's one of the big challenges, I think, of system stewardship is that there's an attribution problem, right? I mean, it's very easy for an individual portfolio manager to demonstrate how they generated alpha. That's all of our systems are built around measuring for that. When it comes to system stewardship, what we think about that is it's really more of a baseline. It's sort of like the very basic way to serve beneficiaries and clients to the best extent possible. And it can be really hard to create individual attribution, but we can start to see in general, if companies are receiving pressure, are they starting to change their behavior? Are they actually starting to move in compliance with the guardrail definitions, with expert guidelines on what might be the protective mechanism of a portfolio? And then investors who are practicing system stewardship, yes, it may not be perfectly attributable to them, but it's certainly at least in part attributable to them. And I think that part of what we need to do to make this grow out there in the marketplace is to come up with better frameworks to measure that. But to my mind, it'll be a happy problem when we have to deal with that. We're so far away from being anywhere close to that I think if we start to get down to that nitty gritty, I will personally retire right off into the sunset and leave that to the younger people to figure out.
Fair response. And we've talked a lot over the last couple of days about just the role in that core understanding, often developed in business schools, and how that really feeds into the problem over time. Are we seeing these ideas show up in business schools at all yet?
I really think we're starting to see it bubble up in a lot of places. And of course, I quoted just one professor. We know that there's a lot happening out of the University of Cambridge in the UK. There's a lot happening at Columbia University, and that's just to name a couple. At the risk of sounding self-promoting, we recently tried to gather together examples of where we are starting to see system stewardship bubble up, and we put them in our latest newsletter and on a blog post on our website. And again, just trying to show that this is something that's happening out there in the field. And so among those will be universities, but also asset owners putting policies into place, various standard setting bodies starting to grapple with these topics and so forth. So while I won't pretend that it's nowhere near mainstream, it is definitely something that we're seeing starting to grow.
Great. And I know you said that you were not holding your breath, but given the current regulatory environment, policy has been top of mind for many attendees. So are there any policy changes or legal clarifications that you think would most accelerate the adoption of system stewardship practices, and any thoughts on how investors could support their adoption?
Yeah, I mean, certainly we're in a deregulatory environment, right? Which is why I'm not holding my breath. I think that remark was maybe more designed to maybe parry a little bit of what I've been hearing out there in the investment marketplace in general, where investors often seem to say that the best role they can play as active stewards is to try to influence public policy. And while I'm not saying that's not necessary, of course it is, they certainly mustn't think that's the only way that they can act, nor would it be satisfactory for it to be the only way they act. I think what we're saying is you also have all these levers on the stewardship side. And at a moment where basically public policy protections are starting to fall by the wayside, we certainly can't repose all our hopes there. Certainly, and I think we're not a public policy shop, so I'm not going to try to go too far into what specific policies we might want to see, but I do want to just recognize the arc of policy development and note that there is a history of investor action driving policy changes. And so if investors start to think about these topics and start to really, really press for dealing better with them, both in the investment landscape and also on the regulatory side, I consider this sort of like the Glenda the Good Witch, using your powers for good. That can ultimately have an effect on the policy side. But let us not imagine that that's the only influence investors have, because that would be quite damaging.
Appreciate that context. I would love if you could share one call to action for the institutional investors and service providers in the room here today.
Yes. I mean, I really think use guardrails. I'm going to do two, Nicole. I'm going to do two. Use guardrails. Look to experts to help you define those guardrails. We don't have to figure all these risks out. Many experts have already very well articulated what the protective mechanisms would be for a lot of these things. As investors, all you have to do is go then implement those and say to companies that you own, this is the expectation. Comply, or we're going to start voting against your directors, right? That's what a guardrail is. And then two, you need to lean on proxy advisors to give you better advice. To quote a very large asset manager with whom we work, he said, every proxy advisor gives me advice as if I held only one stock, and that's ludicrous on its face. System stewardship should be embedded in proxy advice at the benchmark level, not in special overlays and special policies that you spend more to get. Insist on this, because otherwise you can't operationalize system stewardship over tens of thousands of votes every year. Active clientele.
Great. Well, thank you again so much, Sara, for these remarks and thoughtful contributions. I can't think of a better way to close out this forum.
This episode has been brought to you by Metis Global Partners. Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow.
A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.